The Fed leaves the rate hike door wide open, Microsoft ramps up its buybacks, and FedEx is on track. This time on the Morningstar Weekly Wrap. As broadly expected, the Fed didn't move rates this week, but they did say that the case for a rate hike has strengthened and added 3 members of the committee dissenting, saying that they thought rates should go up now, and the market thinks there's an almost 60% chance that there will be a hike by the December meeting. But Morningstar's Bob Johnson cautions that given the weakening of the underlying economy, the increase is far from a done deal.
When the economy was looking a little bit stronger 6-9 months ago, that maybe that would be the right time to put a little cushion into their numbers and start raising rates. But now they put it off this long, and now it looks like we're getting near the end of the recovery, and a lot of things are slowing, and this week there was even more of that.
Microsoft is returning more capital to shareholders with a $40 billion share repurchase program and boosting their dividend. Here's Rodney Nelson's take on the move.
Earlier this week, Microsoft announced a pair of initiatives to return capital to shareholders. First, the company is renewing its $40 billion stock repurchase program to replace the existing $40 billion program that was set to expire this year. Second, the company is increasing its quarterly dividend by 8% to 39 cents per share. While some investors may question these moves on the heels of the expensive LinkedIn acquisition for $26 billion, we remain confident that Microsoft's cash hoard of $130 billion is more than enough to cover these initiatives and maintain high levels of business investment. Further, we are modeling $90 billion in free cash flow over the course of the 3-year stock purchase program, and we are confident that Microsoft will be able to cover all these initiatives. While we applaud these moves, they do not have a material impact on our $62 fair value estimate, and we believe the stock is fairly valued.
The FedEx integration of TNT doesn't seem to be slowing down the shipping giant, says Keith Schoonmaker.
FedEx delivered outstanding results in its quarter that ended at the end of August and proved that management was not distracted by the integration of the TNT Express acquisition. All 3 of its operating segments produced outstanding results in margin, and Ground produced 10% volume growth, which is really outstanding, continued beneficiary of e-commerce fulfillment here in the U.S. TNT results in the period were loss-making. This is no surprise. It was loss-making as a standalone company as well for the most recent quarters. However, we're optimistic about the future of the company as part of FedEx. The firm is investing heavily in TNT, heavy in IT especially, where the firm had underinvested for the last few years. Management revealed a lot of the plan for TNT integration, and we think after 1 year of loss-making results, it'll be accretive to earnings and several years later to cash flow as well. There's heavy investment required here, but management is very enthusiastic about the TNT integration. We see FedEx as fairly valued at this time. We also see UPS as fairly valued. Both stocks are trading in the 3-star range.
And if you missed it, be sure to check out our special report on Retirement Matters this week, where Christine Benz helps retirees find the solutions for 5 tough jobs.